So yesterday, finally, we had some cracks in the Magnificent Seven. Unbelievable, but I don't think anyone would imagine that this was possible. But of course, we've been thinking it's very much possible and highly probable, and we got the first taste of it in a significant way. This what we've been calling for, this great rotation out of overvalued mega cap tech and other overvalued financial assets and into undervalued commodities and commodity equities. We saw a glimpse of that yesterday, for sure, in a significant way. And this is a heat map of the S&P 500. It's organized by sector, so it's also it shows the percentage that the stocks were down, and the size of the squares is related to the market cap of the stock. So all the stocks in the S&P 500, you can see how overweighted the Magnificent Seven stocks are, and you can see they were all down yesterday significantly. And lo and behold, many of the other stocks were up, and this is kind of the exact opposite of what we've been seeing in over the last year plus, where we've seen the leadership just getting narrower and narrower and narrower. And there's actually been a number of other stocks that have been in the S&P 500 that have been down, or we've seen many days where there's a narrow group of stocks up and even more stocks down. And yet the overall index is up because the heavily market cap weighted large cap tech stocks are the ones driving the overall index to be up, even when there's more stocks that are down. Well, that was the exact opposite yesterday. Index was down. The Magnificent Seven stocks were down significantly, and the broader market was actually up. Now, we're not necessarily calling for the broader market to everything else to be up besides the Mag 7 like it was yesterday. We're calling for more of we are calling for more of a significant bear market in the S&P 500 at large, and a more narrow group of leadership to emerge in the commodity and commodity equity sectors. And we did see that yesterday too. Yesterday was just, I call it the first day down for the S&P 500. Today's for the Mag 7. Today's a bounce. Anyway, let's go on to the next. So what's going on? With the Mag 7 earnings growth, we can see that the growth rates have been really strong for some of these leaders like Nvidia, Amazon, and Meta, and Google. In the last year, they had in the first quarter they had enormous growth rates, but now those growth rates are decelerating. Apple is a company with a $3+ trillion market cap that's actually had like five out of the last 6 quarters already negative year-over-year revenue comparison. So that one hasn't been growing at all, and it's still way up there, most valuable company in the world today. And now there's this hope that with AI, which they missed the boat on AI, but now they're going to adopt Chat GPT and come out with some new features in the next generation of the iPhone, and there's hope that that's going to get their growth rate accelerating to barely be above inflation here. But Tesla, we can see the earnings growth has already turned negative, but the point is, at the peak of the business cycle, especially with the AI enthusiasm and hype, there is real growth and real activity being driven into these stocks, but it's over extrapolated in terms of how those growth trends are going to continue, and that's what creates the top, especially when you stack historically high multiples on top of it. But when you see the earnings deceleration coming, and it has a lot more to decelerate, but you already see there's this earnings deceleration in the next quarter, and that's the formula for a top. Let's go on to the next. So we're looking at the S&P 500 earnings estimates for the S&P 500 versus the economic surprise index. So the economic surprise index, Tavi's shown this chart and other similar charts, has been diverging. We've shown it, diverging relative to inflation expectations, which have been going higher in spite of the good CPI yesterday, which is a backward-looking thing. We want to consider inflation expectations, which are unanchored and uncontained right now. But So that's showing the stagflation. But this chart is showing how the earnings estimates are still way up there. So there's this hope, there's this extrapolation of the growth on the recent hype, and yet we have all these other recession signals. The inverted yield curve, which is starting to uninvert now. The uninversion is the trigger for the recession, and the economic surprise index here. We think those earnings estimates are too high, and they're going to be coming down, just like the surprise index is suggesting. Let's go on to the next. This is looking at the correlation between the U.S. economic surprise index, the same chart we were just looking at, and the S&P 500. And what it shows, if you compare it to other time frames, like in 2007, like in 2015, like ahead of the COVID crash in 2020, you can see normally these two things are positively correlated. But when they're negatively correlated, like those times I just flagged, and like today, what you usually see is that the negative correlation is driven by the economic surprise index, turning down, and stocks not cooperating, stocks not wanting to agree with it, until lo and behold, you get the real market crash or correction and the recession, and that's kind of where we are again today. It's just another one of these economic timing indicators that is showing that we are getting ready for a significant correction in the market, if not a crash. We have excessive valuations. We have the declining economic surprises. And so when this thing turns positive, what does that mean? That's when the correlation is positive again. And those are times like in 2008, like in the COVID crash in 2020, like in the market meltdown in late 2015. Those are times when stock prices also start turning down and the correlation turns positive. Let's go on to the next. So this is another chart showing now the overly optimistic earnings, growth rates, and even though we've shown how they're decelerating now, and we have all these other macroeconomic timing indicators and economic surprise index, but what are all those earnings estimates? They're still way up there. Analysts are overly optimistic. They're still looking for 17% earnings growth in the S&P 500. We do not think this is possible at all. We think these estimates are going to start coming down with this earnings season just starting now. We think it's ripe for more, downward guidance, more negative surprises. People say they like to see the beat and the raise. What does that mean? They beat earnings expectations, and then the company raises the guidance, and the analysts raise their earnings estimate. We think we're getting ready for the exact opposite, an earnings season of more negative surprises and more downward guidance in expectations due to all the macro setup that we've talked about.